Good evening and welcome to the analysis of Ferris by Specialized Consulting. My name is Jayden Campbell and I'm a Senior Analyst at Specialized Consulting. Firstly, I will start by introducing my fellow team members. Jessica is our Managing Director, Jake is our Financial Analyst, and Jordan is our Business Analyst. Together in this presentation, we hope to give you a thorough analysis of the company Ferris. Ferris started as a company in 2018 and has been in operation for 8 years. Their main objective has been to maximize shareholder value by being a broad-cost leader through holding maximum market share across all market segments. Other strategies include minimizing long-term costs through aggressive plant investment for the first 4 years that the company has been operating, investing heavily in recruitment and training of their employees, constantly critiquing performance and size of products into targeted and most desirable area for maximum customer satisfaction, having low price products for the industry across all segments, and ensuring greater awareness and accessibility to their products than that of their competitors. Since Ferris started in 2018, the company has had some significant moments over the last 8 years. We believe these moments have shaped them to be the incredibly successful company they are today. Initially, Ferris got off to a slow start with their stock price in 2020 decreasing by $1.65 due to $34 million worth of investments. This led to a net change in cash position of negative $19 million. However, these plant improvements paid off in 2021, leading to a share price increase of $10.40 and a market cap increase of $29 million. Ferris also continued to heavily invest in plant improvements. 2022 is the company's breakout year, with the share price increasing by an impressive $45.86 per share. This led to a market cap increase of 98% to $224 million. 2023 reflects massive investment in plant improvements of $77 million, but given the company's strong finance position, Ferris still receives a net profit of roughly $25 million. 2024 shows investment pays off again, with market cap now at $358 million after a share price increase of $34.97 to $148.17. 2025 brings the company's first emergency loan of $8.96 million due to large amounts spent in plant improvements, dividends, and the retiring of current debt. However, Ferris still finishes the year with a $39 million net profit. 2026 has been another breakthrough year for Ferris, with market cap now over $500 million to $567 million. This reflected a share price increase of $77.17 to $234.42. Overall, a pretty impressive 8 years by Ferris. I will now pass you on to our Managing Director, Jessica, to give a further insight into the performance of Ferris over the last 8 years.
Hello, my name is Jessica Gondowidjojo, and I'm the Managing Director of Specialized Consulting. I'm going to talk about the mistakes that the company made and ethical issues. The first mistake was low-end product R&D. Ferris revised the product on year 6, 7, and 8. Ferris did this because the product was going well in the market and they didn't update the product in the first 5 years. So when the company feels that the product are going outside of the segment circle due to segment drift, they need to revise it every year at year 6, 7, and 8 to catch up. In low-end segment, the second most important criteria is age, that is 7 years. The product is not selling as much because the age becomes 4, 2.5, and 1.9. They can consider one-time revision to the final desirable coordinate at earlier years. Another mistake was made when the company increased the production capacity when the sales is dropped. As you can see from the table, Ferris increased the capacity on year 5, 6, and 7. Ferris did that as a response to increasing demand from previous years, especially stock out at year 5. The product is not as ideal for the segment because of the age, but Ferris forecasts is increasing. Capacity investment and increase in production is not necessary, as we should expect a reduction in sales. As you can see, the plant utilization at year 8 is 63%. As a result, they have too much inventory and emergency loan on year 7. It is mainly because of forecasting mistake, especially in low-end segment, about 1,472 products unsold. The financing activities on that year was paying dividends, issuing long-term debts, and retiring current debts. When Ferris has excess cash for a broad cost leader, they should retire stocks and pay dividends. Dividends should only be paid if the company have excess of cash, but it seems that the company needs cash by issuing long-term debt. Therefore, Ferris spent unnecessary costs of brokerage fee for borrowing and retiring debts at the same time. Ferris could mitigate this by having more accurate forecasts through considering the product score compared to other products in the market and sell excess capacity. Also, Ferris need to plan R&D ahead of time, and they could introduce new product in response to the increase in demand in the market. Ferris need to revisit their company strategy so that the financing decision is coherent with their strategy and pay dividends only when they have excess cash and not borrowing and returning debts at the same time. Despite the mistakes, the company recovers as the company have big profits and good cash position through sales from other segments such as performance and size where there are less competitors in the market. Ferris can implement these lessons and have a better profit and cash position in the future. Ferris labor negotiation is one of the highest in the market. Utilitarian approach means that the goal is to create the most benefit over harm. Negative impact is when Ferris raises their labor wages, the industry experiences strikes and increase in labor costs. Ferris makes it too expensive, especially for those who do not have the same amount of financial resources, so they spend more expenses as they have a higher number of employees. A positive impact is higher salary for employees and also better relationship with the labor union for Ferris. However, stakeholders need to be considered by looking at the market price and the complement needed for other competitors, because it will increase their costs, especially those with higher number of complement. Now I'm going to give the presentation to Jake McNally, our financial analyst. He's going to talk about the analysis of executive shakeup.
My name is Jake McNally, and I will be discussing the analysis of the executive shakeup. On this slide, we look at the company's status after shakeup and have formulated the results into two tables. The top table shows the average scores for the first half before the executive shakeup, with the average results after the shakeup as well. The table below compares the average results, which highlights if the team performed better or worse after the shakeup. We can see that return on sales has increased by 62%, and asset turnover has only decreased by 0.7%. ROA has increased 57%, while leverage has decreased almost 19%. ROE has increased 35% as well. The emergency loan is interesting as it was never used in the first half, but it was used in the second half. This wasn't necessarily because Ferris lost money in one round. They just underestimated the profit they would make that round and ended up issuing too much dividends to shareholders. Sales increased 72%, and the results, such as profits, EBIT, and margin, all had very strong increases in the second half as well. The only other item that decreased was the selling, general, and administrative expenses. Overall, the team improved and performed the best out of all the teams in the second half. Sales continued to improve while profit increased. High profit margins were created by investment in automation in the first half before the executive shakeup, and were then maximised in the second half after the executive shakeup by increasing capacity to make the most profit out of the automation investment. On the next slide, so we're talking about strategy adjustments. The strategy of broad cost leader was maintained after the executive shakeup, as was their presence of their products throughout all segments. In most categories, their price was either the cheapest or in the top few products for cost leadership. The low-end product, however, did lose its cost leadership towards the end, but it did not affect the company's overall profitability. Capacity was maximised after the executive shake-up to make the most of the automation investment that was made in the first half of the year, which helped improve the company's profitability and overall performance.
What is the market's perception of a company like Ferris? Is the company an investment for the short or long term? Well, let's examine key ratios that will help us to share an insight on these questions. Firstly, let's examine the price to earnings ratio, or PE ratio. Looking at the industry, we see that the company is at an 8.4 compared to the industry's average of 10.2. This can indicate that the market is undervaluing these shares. It can also reflect future earning potential, as the ratio takes into account the current stock price. Holding a consistent PE value, which can be seen in Table 2, we can interpret that the ratio is a reflection of investors' optimism of the future growth. As it is below industry average, the market expects that the company will perform moderately over the next few years. Looking at the return of asset will help deepen the understanding of the company's financial health and operating performance. Looking at Table 1, we can see that over the industry standard, Ferris is above average, indicating that the financial health of the company is at a good level. In 2026, the return of asset was 21%. That's roughly equals to $1 of profit for every $5 spent on investing in assets. On Table 2, throughout the 5 years, we see that the business is continuing to earn increasing profit, highlighting the 8.3% increased in Table 2, or can be seen in Table 2, from 2025 to 2026, shows that business management are striving into increasing greater profits from assets. This gives increasing confidence to investors that management are actively performing. The share price has increased 49% over the last year. This is showing that investors' confidence in the price as well as the company performance. The market valuation and market cap is at a 567 million and is increasing each year. Gaining momentum, stock price has increased historically. For the short-term investment strategy, risk is increased due to the economic and market factors, especially in the tech market, but with a consistent increased share price, holding shares or buying shares for the short term could see possible rewards. Looking at the PE ratio, we can see that the company has a potential to increase growth as the market holds and the stock undervalued. Long-term investing reduces the risk, and financial health of the performance is solid and strong in this company, leading to the capacity and the ability of the company to perform using resources efficiently due to the return of assets. This stock should be held both short and long term within a diverse portfolio. To summarize Ferris, this technology company, with its broad cost strategy, has led to significant sales and profits since 2018. Over this time, Ferris has made mistakes and costly lessons learnt, but with a market cap just over 500 million in 2026, management have amended these mistakes and been able to adapted to the market and the executive shake-up to produce a company that is financially solid. As the share price and performance increases, Ferris is rewarding and sustainable company for the short or long-term investment or investor over the next coming years.